the one, the only real estate rock star, J. Scott Shield. Now, you may have seen Scott on Fox Business Channel. He's a frequent contributor to Stuart Varney's program. He shows off his expertise in global finance and investing for the world to see. He's a star real estate developer, serial entrepreneur. He's even a feature film producer. And Scott is super successful, and it is his passion to inspire others to achieve their dreams and impact communities. And so Scott's got a special event in Dallas in a few weeks he's going to be telling us about, as well as a really cool ebook that can help you with real estate investing. So Scott, it's an honor to have you back, man. Welcome. It's an absolute honor.
Dr. Steve, it is a pleasure to be here with you and your audience. Thanks so much for inviting me back. We always love when we get the opportunity, to sit and kind of riff on everything that's going on in the world around us today. Plus, I got to tell you how much I love your audience.
Oh, man. Oh, they're right back at you. They love you, man. Do you have an opinion on urban versus exurban? Because, obviously cities in the Northeast and Chicago and LA have been losing population. California in general is losing population, but I guess scholars are calling it exurbanization as opposed to the urbanization in the 19th and 20th centuries. People fleeing to the exurbs, fleeing to the suburbs. Any sense on that in terms of commercial real estate?
Yeah, certainly the urban core right now is suffering across the board. Office, retail, hospitality suffering mightily. And the problem there is that the shakeout is going to happen over half a decade. So you can be opportunistic, but you've got to have holding and staying power if you want to play in that arena. So you've got to be well backed, and you've got to understand that you may have an opportunity to acquire something like that well within the next 1 to 3 years. So it's a 12 to 36 month entrance to make the timing right. And then it's probably 24 to 84 month, reestablishment of that value. In my humble opinion, it will absolutely, reemerge.
Rebound,
it will do well. It's just, can you hold it and can you ride through that winter in a way that says, yes, I'm going to capitalize on coming out at the other end. And even more so, I'll say it this way, is it worth it? Do I want to wait that long? And do I want to fight that fight? Now, when you talk about, the exodus from the urban core, I think that's against kind of some of the leadership we've got right now. I think the leadership is maybe a little opposed to that methodology. I think more consolidation into the urban core is where they're going to incentivize us. And, some of the things with opportunity zone investment and those types of things, those types of tax shelters dovetail very well with the devaluation, because it allows, and this is going to start a little sinister, but some of the devaluation of that urban core, I think, really plays into the cronyism that's going on in some of those long-standing congressional seats. Right. So to me, I believe in the suburbs. I believe in the American dream of home ownership, and a 1 acre plot and a white picket fence and a dog and 2.5 kids, and go out and live your dream on your terms. Right. And I think that even though a lot of the youth of today, some of the millennials are maybe not thinking that way now. As a family man, I know that changes dramatically once you start to introduce your aspirations about, how you're going to build that family and how you're going to raise your children. That becomes easily the best option. And so as they move into that stage of their lives, they want to be transient. They want experiences. They don't want necessarily things, but that's really truly not sustainable, right? Over the next 30 in your 30s, 40s, and 50s. You do want to put down roots. You don't want to be a rolling stone. And I think that comes home to roost. And so, the ability to get in, to do some covered land plays, right? Where you buy a piece of dirt relatively inexpensively because there's not a lot of development demand right now in a lot of communities. Right. Can be a nice safe haven to park money, because like they say, they're not making any more of it, right? Right. So, there's a number of different ways. And really, I think it also depends on, what stage the individual that we're speaking to, in this session who's listening is in their life. If you're in your 50s and 60s, you're looking at it way differently than if you're in your early to mid 20s or, starting your 30s with a new family. those things will always be very different in your perspective and approach as well. And what I love about your platform is we get to expose people to every one of those.
Yeah.
And it's really a customizable approach. But I'll tell you, anybody who's not thinking fixed assets right now, they're going to look back in 5 years and regret it.
Yeah, that's so good. Actually, if you don't mind, just give us a sense of what is a fixed asset, as and maybe go a little Kiyosaki on us here. What's
Yeah,
a
no,
fixed
sure.
asset versus, a paycheck, for example?
Right. So a fixed asset is really something that is kind of, as it says, it's immovable, right? It has a place, it has a location, usually deeded. Sometimes there's a structure there, sometimes there isn't. We pay attention to things like apartment buildings of really any size. You can have, retail shopping centers. You can have an office building. Small bay industrial right now is very hot. When you talk mobile home parks, that's kind of fixed asset because of the infrastructure. So you've got, your slips, you can get out there, and they're incredibly popular investments right now because, the cost of apartments is so outrageous. But they are also mobile home parks covered land play, meaning that you can hold on to the land for, a higher and better use 5, 10, 15 years from now, but generate cash flow on it today without necessarily committing to one use over another. You can also talk about small bay industrial. More new companies were formed last year and this year than at any point in time in decades. So a lot of people are starting new companies, and you can work out of your garage or your basement for a period of time. But what we find is that a lot of these folks are trade persons who are working, as a painter or as an electrician or, whatever your particular discipline might be. And you say, you know what, since the economy's crazy and my company isn't doing it, I'm going to strike out on my own. And I could probably do as well with that. We've saved up some money from the pandemic and not traveling and doing some of those other things. So they've struck out into their own businesses, and they're looking for these, 1 to 3,000 square foot kind of, concrete block building with a roll up door, a small office that they can operate out of. And they're paying $1,000 or $2,000 a month, maybe a small fee, but they're really building that American dream of entrepreneurship, which is what we really want to foster. And so those buildings can be had right now, well constructed in good areas, very inexpensively. And, it's what we see as the next real wave of, an opportunity to capitalize on true real estate investment right now. So, again, fixed asset, again, I don't know if that's maybe a too long-winded way of discussing it, but it can be so many things. I mean, anything from your local McDonald's on the corner all the way to, that abandoned gas station that you're going to knock down and find a higher and better use for. So they don't have to be expensive. But what I will say, Steve, and this is something I think, that people are going to love to hear, is that you don't have to be wealthy to consider these things, because it's an income-based investment. The asset itself brings most of the money that you'll need to acquire it. I know that sounds kind of crazy, but because it throws off revenue, it allows you to leverage it. And if there's an ability for us to increase that rent, either by managing expenses down or by adding a couple of tenants or raising rents to market, and those are really the three ways to do it. There's a lot of nuances and facets to, those three categories: reducing expenses, raising rents, or improving occupancy. But those are basically the three principles. If you can clearly see that you could do that, if let's say you cleaned it up and made it look better, well, you can add hundreds of thousands of dollars in value to an asset with just one lease. And if people knew that connection, I think they'd be in real estate, certainly as one aspect of their portfolio, really universally.
Yeah, I think the imaginative terror is that we're stuck in like you said, just the residential real estate model. I'm going to buy all this property and it's just going to sit there empty, as opposed to, like you're saying, buying those properties made up of, what is it, 4 more units, 5 or more units that are already.
Once you get to 5+ units, it's commercial.
5+, and it's already generating income. You're actually buying an income machine, as it were, and it's a different mindset. It seems that you really have to sort of shift the way you think about what you're buying and the like. I guess we think of it like buying a car. You know, once I buy a car, it's just gonna be an expense to me from now on. You know, it's gonna go down in value in life. But what if you had a car that every time the farther you drove it or something, the more earnings you would get? That's an asset. That's a whole different,
it's like a taxi, right?
Exactly.
Every time somebody gets in the seat, you know, they're handing you some money, and you get to hold on to that for a long time. So I think, you know, what we talk to people about, you know, in this entry level perspective, is not only can you buy them occupied with cash flow, because that's fantastic, but if you, let's say you find an income property that has, let's say 8 units, but only 4 of them are filled, right? And let's say that the other 4 are a little beat up. Well, you can get in with a little bit of elbow grease and a little aesthetic, cosmetic improvement. You know, you can fill those. And when you make that improvement, right, it really ratchets up the value. And the way that, let's say, a multifamily apartment complex would work is, once we have operated it for its calendar year, I now have an income statement. You know, it's kind of the report on how the property performed this year. What did it generate in income and rents? What did I collect in other income categories? And what did I pay out to own this asset? And what is left over after you take all of the income and subtract all of the expenses, called the net income. And there's a very basic formula that people, you know, try and make sound bigger than it is, called cap rate. It's capitalization rate. And really all it is a return on investment. So I'll give you a very simple example. If you had an apartment complex and it generated, after collecting all the rent, paying all the expenses, not counting debt to own it, if it threw off $50,000 a year, if you were in a 10% market, 10% cap rate market, it's really a 10% return on investment. So $50,000 is 10% of 500,000. So that's a $500,000 asset, okay? Because 50% is a 10% return.
Right.
Now, if I'm able to raise that rent from that net income from 50,000 to say 75,000, which is very doable. I mean, we do it literally every single day of our lives, right? Myself and my other clients and customers. When you do that, at that same return on investment, let's say, look, I invest in apartments all the time, but, you know, Dr. Turley, in order for me to make an investment, I absolutely need a 10% annualized return. You say, well, I've got this one that's got $75,000 in income now. We've just recently renovated. It's very clean. You say, well, I'll pay $750,000 for it all day long. You just made $250,000 on your effort. And that's what we call forcing appreciation. Rather than in residential real estate, where more often than not, you got to wait for the market to take you up and you're not really in control.
Right. Right. Wow. Oh, that's great. Click on the link below. Scott has an amazing ebook called Bigger's Better. And we're going to talk a little bit more about that later on, but that'll be a perfect way for you to be able to keep up with when that step-by-step video on how you can do this is put up. That'll be amazing.
Yeah, it'll be great. I think that they're going to love that. And I think they're going to find it to be educational, informative, and it's going to open their mind to something that's really all around them, generating wealth every day. And it's for most people, unfortunately, it's just not something that they believe they can tap into. But I can tell you, nothing could be further from the truth. I mean, wow. Legitimately, if I could do it back then, anybody can do it. And I want you to know that I literally have hundreds of thousands of students all around the world who are implementing these plans. So you absolutely can do it. And I'm going to prove it to you. And if I don't prove it to you, then, you know, I guess the worst thing you did was waste 15 minutes with us.
There you go. Well put. I love it.